The U.S. Federal Reserve is expected to raise interest rates for the first time since 2006, and reversing the past 7 years of extraordinary monetary policy looms as being an experimental, possibly bumpy liftoff. The interest hikes are expected to have a ripple effect in African economies, with some economies predicting currency instability and foreign capital outflows, while central bank governors across the continent have buckled up in anticipation to the Fed Reserve announcement tomorrow. So let's get more. Daniel Branches is live for us in Washington. So Daniel, usually when we talk about higher U.S. interest rates, they tend to depress the values of emerging market currencies at a time when many emerging markets economies are already weakening and their currencies slumping against the greenback. Is the Fed's rate hike likely to exacerbate the currency turmoil?
Well, I think so for countries or companies or individuals that are very exposed to US dollar debt. This is a particular concern. On top of that, if you're a country that has a lot of commodities, they're obviously priced in US dollars. And as the cost of buying dollars goes up, as the dollar becomes a stronger currency on world markets, then the price of those commodities for you goes down, and that's a problem. So I think this speaks not just to Fed policy, but also to diversification. But I would say that over time, a lot of the economies in Africa have learnt these lessons from the past, that they shouldn't be overly exposed to this. And the Fed has projected many, many months in advance that it was going to do this, that it was going to start to raise rates when things looked to be cooking well for the US economy. This situation has been well predicted by the markets thanks to Janet Yellen and her colleagues. So it's not as though these economies have not been warned. But yes, I think there is going to be some bitterness ahead for some of those who are most exposed.
And there's also concern, Daniel, that the rate hike will lead to capital outflows from the emerging economies. And this, of course, destabilizes those fragile economies. What's the response from your end about this?
Well, I think it's certainly true that the market generally has in the last few months become much more risk averse. And that means people consider some of the emerging markets, developing markets, particularly those in commodity areas, as being much more risky in the current climate. So I think that trend is likely to continue, although we obviously can't predict exactly what will happen. But I would say this, what Janet Yellen is essentially saying is that the risks of not doing anything at this point are now outweighing the risks of staying as they are. Namely, the risk is that down the line, inflation, she thinks, will start to pick up. If inflation picked up and they didn't raise rates, then they'd be in the position to having to sharply raise rates, suddenly, dramatically destabilizing the markets, destabilizing the chances of a strong US recovery and a global recovery. So I think some medicine now, she says, is better than some very harsh, strong medicine later on, which will risk the recovery. So a little bit of mild pain now is much better than down the line a much sharper adjustment for Fed policy.
All right, we'll leave it there for now. Daniel Branches in Washington, thank you.